Sell a put option already. What are you waiting for? It's one of the most important things you're ever going to learn in order to grow your account and generate income. But before we get going, check out Capital Curiosities. It's a great little channel talking about fiscal histories, especially financial fiascos that have gone on throughout history. We've got some interesting ones about Samuel Insull and the electric monopoly, John Law and how he's sold iconic New York sites over and over again. Coming up on Sunday, they've got Michael Milken, the junk bond king, talking about his rise and epic fall soon after. Really fun to watch if you're tired of the news cycle and you like something just entertaining. Capital Curiosities has got you covered. Go ahead and check that out. Anyways, let's move on. So we're talking about selling put options. So right here, this is my Webull options chain. I'm going to tell you today about a couple of different tickers that I think are interesting for practicing, that are going to be low risk in terms of capital that you need to put up in order to pull off the trade. And I think that they're great for, learning the ropes of selling put options and to build confidence. Okay. Anyways, the first one here is going to be American Airlines. If we look at the chart for American Airlines, this is a weekly chart, by the way. Let's go to a daily. It doesn't move a whole heck of a lot, right? Actually, let's do a weekly. It looked nicer on the weekly. All right. It doesn't move a whole heck of a lot, as you can see, right? Okay. So can I do a range? Let's do a 6-month range. There we go. Yeah, that's better. All right. No, I didn't like that. I hated that, actually. Max. To the max. All right. Anyways, you can see here that we're going to go to a weekly on that. All right, cool. Well, on the weekly, you can see it kind of holds a range largely between about $12 and about $20, sometimes dipping lower into the single digits before recovering back into that range. Okay. And it's been doing that for about 3.5 years now. Okay. Not too bad. Not too bad. That's why I'm interested in this one. It's one that doesn't have a ton of movement in it. It doesn't have no movement, but it doesn't move like crazy. It kind of stays in a relative range. You can kind of guess where it's going to go. Okay. And if we look at the options chain here, if we look at the 30 delta, which if you remember the 30 delta, it's over here where my mouse cursor is right now. The 30 delta is generally where I target when I am selling a put option. If I'm not as confident, or if the market's been dropping kind of dramatically, I might look at a 20 or even a 15 if things are really volatile like they were in April. Early April, like February and April. But right now, I think that 30, for me anyways, is a decent risk scenario for me, which means I have 70% chance of success or a 30% chance of failure. The only thing I don't love about this is that the implied volatility is low at 52 right now. And if I bring up the calculator, you can see you're going to collect between 33 and 37 cents per share. Let's call it 30, split the difference, call it 35 cents per share times 100 will be $35. And we take that $35 divided by $1,100 because it's $1,100 to put on the trade because it's an $11 strike. 11 times 100, 1,100. Okay. Anyways, let's see what that comes out to. Times that by 100 to get our profit percentage. It's 3% profit in a month. This strike is June 13th, which is 29 days in the future. So this is 1 month. And push that over 12 months, you're looking at 38%, which would be a bumper year in the S&P 500 if you were to get it. So 38 is nothing to spit at. Now, it's not great. It's not fantastic. You're not going to become a millionaire overnight doing this. But if you were consistently making 38% year over year, you will eventually become rich. And if you're young and you have a long time horizon, you're really going to be rich doing this. Anybody that is young, I preach this strategy to. If you're young and you got lots of time ahead of you, this is going to have you living large in your 20s if you start it in your early teens or even late teens, like your late teens to late 20s, early teens, early 20s, right? Give yourself 10 years on this. You'll be doing really well. Okay. And yeah, that's basically it. That's what I would do on this one. AAL, that's American Airlines. Another one is ACHR. They do drones. They do mostly military drones these days, and some other things. And they're also a low-cost stock. They're under $15. They have Their implied volatility is in the hundreds here, so not too bad. I'm not looking at the 1 day. Let's go to the 29 day, so 1 month out. And if we go 1 month out on this bad boy, and we go down to the 30 delta, which is right here, it's a 29 delta, that's going to be also an $11 strike. But you're getting almost twice as much premium. Look at that, 61 to 68. We split the difference, call it 63. We're looking at about a 6% per month return on Archer Aviation. 6%. If you're doing 6% per month times that by 12, you're looking at 72% in a year. That is absolutely phenomenal. And I have been selling puts on Archer. I actually have some open on Archer right now. I think I've got like an $11 or so, because it was lower yesterday or the day before, whenever I opened it. And we can look back here on the theta. So we can see our implied volatility now. Let's see at the 30 delta, our implied volatility is 83 here. So that's not bad. It's not bad. It's not huge, but it's not bad. It's not bad. It's a lot better than American Airlines. But this also moves a lot more than American Airlines. So there is risk here. There's more risk, I think, on Archer Aviation than American Airlines. But Archer is partnered with Palantir. They are partnered with the Department of Defense. They are making money for sure. And you can come over here and look at the theta is $1.6. So $1.68 per day that you're losing on that. So, and that will grow over time. So unless you get a stock move, unless you get a move in the stock, the value of this isn't going to drop fast enough for you to like reload it every couple of days. You'll probably hold it the majority of the month. But that barrier to entry again is less than $2,000, and you can practice selling a put, learn how it works, get comfortable with it, and then eventually you'll be moving on to things like Tesla or Nvidia, pulling in $500-$600 in premium per month per contract. So these are the ones where you get your feet wet and you get comfortable with the way that it works. And the way that works, if we come over here, is basically what you're going to do is you're going to sell to open. You will choose the sell to open option when you click on these. You want to do the sell to open option on here, and then it'll show up as a -1 in your account, versus when you buy one, it shows a +1. And the thing to keep in mind is that when price goes against you, you're not in any trouble at all until price goes beneath the strike price. So in this case, as long as the price is above $11, you're totally fine. Even if the contract shows a negative balance, it will show that. Sometimes it'll show a pretty large negative balance, but as long as price is still above your strike price, you're not in any danger at all yet. It's only when it becomes below the strike price on a put option, that is, on a put, when it becomes below the strike price is the only time that you're entering any sort of danger zone on that. And even then, referred back to that first video that I'll link this one to at the very end, for rolling and how to roll your way out of a bad situation if that is to happen to you. Let's move on to one more. RCAT. RCAT is not RACT. RCAT. Also drones. They also do military drones. They are also partnered with Palantir. They are also partnered with the Department of Defense. Let's see what they are for a 1 month out. So this is a $6.69 stock. Okay, $6.69, right? So less than $700 to practice selling puts. Okay, look at the implied volatility is nearly 100 on the 29 day. And if we go out here to the delta, and the 30 delta is right here at $6. So you only need $600 to put on this trade. You'll get between $25 and $35 of premium for it. And you got, let's see here, $30. Let's split the difference, call it $30 divided by $600 times by 100 to get your percentage amount. That's 5% per month. That's 5% per month, or 60% per year. 60% per year that you could get off of doing RCAT puts, selling RCAT puts. Not so bad. And if we come over here, theta is going to be $1 a day, so you will be holding this the majority of that month to collect that premium. But this one's really low barrier to entry. If you have an account smaller than $1,000, you can still practice selling puts on stocks like RCAT. Let's do one more. This one, though, is also going to be that higher risk. We're going to do two more, actually. Two more. Let's take a look at BBAI. another really small cap stock. This one is Big Bear AI Holdings. They occasionally spike up to like $8 or $9. So I don't know if you'd necessarily want to sell a put on it or not, because the upside is probably better with other methods, but it is a $3.60 stock. So $3.60. You need less than $500 to put on this trade. Less than $500 to practice selling a put. Can't get any better than that. The implied volatility is huge. It is at 128%. The 29 delta is the at the money strike. The 29 delta is the at the money strike. Okay. And that is $3.50. So you need $350 to put on this trade, which is actually $305 because you will collect about $45 of premium. And if we come over here, we bring up the calculator, $45 of premium divided by $350. We are looking at a 12% return, 12.8% return, times that by 100 to get our percentage, and we times that by 12. You're looking at 154% per year practicing selling puts with BBAI. Now, this is probably the highest risk one on the list. This one's probably the most at risk of bankruptcy if things don't go well, but your biggest risk is $350 if that is to happen. So I'm not too concerned about that. I would take that risk in order to practice selling a put. But of course, if you only have a $1,000 account, maybe you don't want to go with this one. It is the highest risk I've mentioned so far. Now, you might be thinking that you may not be able to get exposure to stocks like Tesla if you have a less than $30,000 account. And I'm going to go ahead and tell you right here that that's not true. We've got TSLL. This is the 2X Tesla Fund. TSLL, 2X Tesla Fund. It is trading for $14.50. And guess what? It also has options. Right? This also has options. And if we go to a 30-day on this bad boy, come down here, you can see that we've got 117% implied volatility. That is nice. That is perfect. That's exactly the kind of thing I want to see. If we look over here on delta, we have like a 30 or a 26 delta. I'd probably lean towards the 26 delta, because if you come over here and look at the premium's pretty good. So I'd go this one, since it's a 2X levered fund on an already volatile stock. I don't necessarily want to do 30. I want to get closer to 20. I might even do like a 23 or the 20, so I might do like the 11.5 just because this thing moves a lot and I'd be a little bit scared. But if I'm feeling like Tesla's bullish, even if it comes down here, I might want to buy it there. Anyways, if we look at the 20, let's look at the 23 delta. So between 74 and 83, so we can call that about 77 or so. Let's call that about 77 premium. 77 in premium divided by $1,200. We're looking at a 6.4% return per month on this bad boy. And if we times that by 12, we're looking at a 77% return on selling puts on this exposure to Tesla. And if we go look over here, theta on that one's going to be about $2 a day. So you will be holding this the majority of the contract unless price moves up. And as you know, Tesla can move wildly, so it could go up dramatically, potentially. Anyways, those are several tickers that a small account can practice selling a put on and get that experience, get that feel for how it works. Remember, when you're selling a put, you are selling to open. You sell to open and you buy to close. The premium shown here is what you will collect. That is your profit for selling that put. And if everything goes well, you get to keep the vast majority of that. One thing I like to do is that if my put gets into 40% profit within the first 2 or 3 days, I will close that position and I'll open a new one in order to make more money. And then after that, after the first couple of days, I will set and forget a close order for that position at 80% profit. So for it's $100 in premium, when the contract value is at $20, I will close it out. Doesn't matter what time it is within the life of the contract. And then I'll move on to the next position. Anyways, that's all I've got for you today. Please like, comment, subscribe, share this video. Check out the Trade Cave store, link in the description, as well as the channel bio, and have a profitable day.